Hello, and welcome to the next edition of Fixed Interests, where we're going to discuss Turkey. My name is Paul Gamble. I'm head of the Emerging Europe Sovereign team at Fitch, and today I'm joined by Erich Arispe, a senior director in the team and our lead analyst on Turkey. We've taken a number of positive rating actions on Turkey following the significant change in economic policy in the middle of last year. Most recently, we upgraded Turkey's long-term foreign currency rating to B+, and placed the outlook on positive in early March. And this was just ahead of local elections. So Erich, how important were Turkey's local elections for the sovereign credit profile, and have the results changed our thinking on the economic policy stance?
Thank you, Paul. So, as you know, for most sovereigns, politics have a great influence in the type of policies implemented, especially gearing up for elections. Turkey has been not an exception on this regard. And as a matter of fact, politics or the political influence of the political authorities in Turkey has been a determinant factor in the monetary and overall policy direction in recent years. So last year's elections actually represent an important point because first you had a destabilizing policy mix that increased the risks to macroeconomic and financial stability. And after the appointment of the new economic team in June, headed by Mr. Mehmet Şimşek, we saw a policy pivot in which policies were geared up to reduce these macro-financial stability risks, as well as address some of the long-standing weaknesses in Turkey's credit profile, namely inflation and the buildup of external vulnerabilities. One of the questions about the policy adjustment was its durability. So the elections at the local level for March 2024 represented sort of a milestone in which we could assess not only how long or what was the durability of the policy adjustment, but also understand the commitment of the political and economic authorities to the new direction of economic policy. So at the time of our rating affirmation of B with a stable outlook back in September, we highlighted that the policy mix did enough to reduce macro-financial stability risks. But we were surprised on the upside as the central bank and economic team were able to over-deliver, or let's say front-load the monetary policy tightening in spite of the proximity of the local elections, as well as the improvements that we saw in terms of adjustment of inflation expectations, for instance, as well the narrowing of the current account deficit. Of course, elections are important, and our expectation is that additional monetary policy tightening would be forthcoming after the elections, and unexpectedly, the central bank actually lifted policy rates to its current level of 50% just a couple of weeks before the local elections themselves. So for us, that demonstrated the commitment of our authorities to actually undertake the rebalancing of the Turkish economy, as well as that the political space probably was greater than what we initially anticipated. Now, on the political side precisely, one of the important elements, of course, has been the very public political support at the highest levels provided to the economic team. We have seen President Erdogan repeatedly in the round 2 election providing the support to the economic policy team direction, as well as even, providing a justification for the higher interest rates that were required in order to bring down inflation and address the macroeconomic imbalances. It is important to note that after the elections, and in spite of the adverse result for the government, the president, in one of his first statements, also restated this support for the economic policy team, and I think that's important in order for us to feel more comfortable about the political space that is present for the current team to deliver lower inflation. Finally, it's important to note that after these local elections, there is a hiatus in the electoral process in Turkey of 4 years, which of course should allow time for the policy team to maintain the current policy directions, as well as start to show some results of the policy adjustment.
Thanks, Erich. Could you elaborate on our current assessment of the main elements and the direction of the policy mix?
So it is important, I guess, to highlight that the normalization of economic policy in Turkey has as its center the normalization of monetary policy in terms of, again, going back to higher monetary policy rates, signaling and trying to influence financing conditions in the local market. And these are supported by a combination of macroprudential measures that seek also to improve the potency of monetary policy. But given the distortions that were, of course, introduced over the past couple of years with these same financial regulations, we can not only assess the policy stance and its effectiveness just by looking at monetary policy. Other policies have to go in place in order to improve the effectiveness of the monetary policy adjustment. So on the monetary policy side, as we discussed earlier, we've seen the policy being hiked very dramatically in the second half of 2023. And in its recent meetings, the central bank has indicated that they intend to maintain tight financing conditions in the domestic market, both supported by this 50% interest rate, as well as using additional financial regulations to achieve the objectives of rebalancing domestic demand, as well as supporting de-dollarization. Now, going back to the point about the introduction of this web of financial regulations in 2022 and early 2023, the monetary policy by itself cannot deliver the rebalancing of the Turkey economy or reduction in inflation, because the effectiveness has reduced as transmission channels have weakened. And this is a result of an extended period of artificially low interest rates, inflation expectations that are unanchored, high financial dollarization, as well as the distortionary effect of these financial regulations. So monetary policy tightening is important, but it has to be supported by other policies that are geared in the same direction of cooling domestic demand. And this is where fiscal policy and any fiscal policy adjustment becomes important. We saw some easing at the beginning of the year as we saw the acceleration in spending, and this created a couple of problems for the central bank in terms of, fiscal policy supporting actually domestic demand, while the central bank was trying to do the opposite, as well as increasing the challenges for liquidity management by pumping liras into the domestic market. Now, after the election, the economic management team has signaled that they intend to tighten fiscal policy. They have actually announced a series of measures to try to reduce expenditure, and announced as well that they intend actually to have a lower deficit than originally projected in the medium-term program. So just to remind you, it was 6.4% budget deficit for this year. They mentioned they intend to have a 5.2% of GDP deficit and probably try to aim lower with additional measures probably that could be rolled over later in the year. So it's important that this consistency will be improved, because then the effectiveness of monetary policy in cooling domestic demand can actually be enhanced. We expect that the policy direction and this improved policy consistency will deliver lower inflation or slow down the pace of inflation in the second part of the year, as well as continue to support the external rebalancing of the economy, and this in terms of a lower current account deficit, as well as supporting a reduction in dollarization, improving international reserves. It's also important to mention as well, beyond fiscal policy, the pace of credit growth and measures that can rebalance that away from consumption are important, as well as any future minimum wage adjustments. The expectation that this probably will be more consistent with the objective of cooling down domestic demand, and that will be, of course, in sharp contrast to what we saw at the beginning of the year with this significant minimum wage increase.
Thank you, Erich. So what's our view on Turkey's progress in tackling the key macro and external credit vulnerabilities?
So we have highlighted repeatedly that probably the main weaknesses in Turkey's credit profile are in terms of high inflation, and this has only become worse in recent years, but also some more perennial vulnerabilities, especially on external finances, and that's the high current account deficit, as well as the weak international reserve buffers, as well as the vulnerable composition of reserves. Probably in recent months, or even in recent weeks, to be more precise, what we have seen is actually much more noticeable improvement on the external side. First, on the current account deficit, the trend that we've seen since the second half of last year has continued, and the 12-month current account deficit for March has come down at $31 billion. And to put in perspective, that's almost half what we had in May of last year, which was around $60 billion. So significant progress there. And we expect the current account deficit to remain close to this level. And that's based on the expectation that we have is reduced demand for gold because of the reduced exchange rate and policy uncertainty, as well as easing on the demand coming from the consumer side, as we expect, as we discussed previously, that a tighter policy stance will slow down domestic demand. On the international reserve side, this is probably where the progress has been more noticeable, as we said, in recent weeks. First, this increased demand for FX that we saw previous to the local elections has dissipated. And as a result, what we've seen is a reduction in financial dollarization, as well as FX protected deposits. Again, starting to decline at a much more noticeable pace and are currently around $68 billion. And that's less than half of what we have at the time of August last year. On external financing, not only financing conditions have eased, but also we have already started to see some of the return of foreign investors on the equity side, in terms of also government securities in the local market, but also in terms of swap transactions with local banks. So this overall improvement in external financing conditions and sentiment has resulted in improvement also in international reserves, which have increased significantly by about 10 billion since the end of March to 134, and that's as of May 10. And also in terms of net international reserves, we have increased actually a little bit more at 15 billion compared to the end of March. What is more striking probably is the point about composition of reserves. And what we have also seen is that the net foreign asset position of the central bank has improved dramatically as a result of the reduction in FX swaps with domestic banks. So as a point of reference, we had a peak of about minus 75 billion, and that's excluding FX swaps with local banks and other central banks. So minus 75 billion in March, and now the latest figures for this week show that we are at minus 20 billion. So a significant improvement. On the inflation side, it's a mixed bag. On the one hand, inflation expectations have come down, especially looking at 12 months ahead, to about 33. And also what we have seen is the slowdown on month-on-month inflation. Nevertheless, we have to keep in perspective that April inflation annual basis was close to 70%, and that domestic demand is still showing signs of resilience. Now, we have seen the central bank adjust its end-year inflation projection to about 38, and that's the middle of the range, slightly up from 36. And that's not far from actually from our expectation for end-year inflation in March, which was 40% by end 2024. Nevertheless, of course, the main challenge on inflation is not only achieving or getting close to the end-year target for the central bank, but also thinking that bringing inflation closer to peers or closer to modern emerging market standards will require a much sustained effort in terms of tighter policies.
Thanks, Eric. And finally, the market seems to be very upbeat on Turkey's economic prospects. CDS have fallen to levels not seen since 2018. So what would it take for Fitch to see any further improvement in the rating?
So we've touched upon those when discussing, what we've seen in terms of recent developments on the key vulnerabilities. So what we've highlighted is important that for us to see more progress in the fight against inflation. So for us, we need to see evidence that there is progress in the sustained disinflation process, and also greater confidence that we would only not see declining inflation because of base effects, for instance, but actually the current policy normalization will support a sustained decline in inflation over the medium term. So that's number one. And yes, we acknowledge the improvement in international reserves and the composition of this, but then again, we have to see to what extent there will be a sustained strengthening of these external buffers. For example, if we start to see much more noticeable, much greater levels of capital inflows, which also, again, would buttress further improvement in the level and composition of international reserves, as well as reduce financial dollarization.
Thank you for your insights, Eric, and thank you to everyone for listening. For more information on our views on Turkey, you can access our website on www.fitchratings.com. We hope you will join us for the next edition of Fixed Interests.